Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, January 8th, 2025. As always, we'll start with the executive summary from today's lit-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will DOGE, the Department of Government Efficiency, save the bond market and by extension, the bull markets and risk assets? Our answers are, yesterday saw steep sell-offs in risk assets and bonds alike amid clear evidence of our sticky inflation theme. Bond yields, which are up about 75 basis points on a real basis since the Fed began cutting policy rates in September, have recently breached levels that are causing problems for asset markets. Enter President Trump, who stated plainly during his Mar-a-Lago press conference yesterday that interest rates are too high. As previously discussed in our research, President Trump may opt to kitchen sink the economy with tariffs and spending cuts, the both of which are likely to be features of his initial policy mix per the latest forward guidance out of DC and Mar-a-Lago. How much of each will determine how much the economy slows throughout 2025. A slower economy equals lower bond yields and flat to up risk asset valuations. A too slow economy equals lower bond yields and lower, much lower risk asset valuations. We are on record celebrating DOGE's attempt to shrink the federal government, but we continue to express skepticism regarding the agency's ability to achieve its goal of significant deficit reduction when very large drivers like Social Security and Medicare are off limits. Refer to our December 28th Around the Horn presentation and our Luke Groman protocol discussion for more details. As always, we'll wrap up with a question from our community. This one's regarding TGA spin down and market impact. It says, hi, DD. I was wondering if you could shed some light on the process if the TGA spin down occurs. Specifically, does the TGA typically purchase bills in this scenario? Additionally, would this development have a bullish effect primarily on domestic markets, or might it extend to global markets? While I could likely find some information online, I greatly value your expert perspective on how such events tend to influence markets in practice versus expectations. Thank you for everything you do. Hope your family and little one are doing well. God bless. God bless you as well, brother. I appreciate the kind words. So let's get back into unpacking the question here. So does the TGA, I'll just go down in order. Does TGA typically purchase bills in this scenario? So TGA is not purchasing anything. So what happens in the TGA spin down cycle is the Treasury hits the debt ceiling and they're unable to borrow debt on a net basis, on a go-forward basis. They can roll over existing debt, obviously, and they typically prefer rolling over bills because it's a lot easier to manage than sort of issuing coupons and kind of getting locked into that. Because if they roll over bills, they can obviously get the benefit of incremental tax receipts and things of that nature to the extent tax receipts come in above expectations. So that's one part of that. Additionally, would the development have a bullish effect primarily in domestic markets, or might it extend to global markets? This is, liquidity is fungible across borders, geographies, and markets. So if anything that has any liquidity positive dynamic that has an import, that has a positive dynamic on U.S. markets is likely to have a positive effect on global markets as well. What we've seen in the previous couple of debt ceiling TGA spin down cycles, if you go back to the second half of 2021 and the first half of 2023, you had a modest gain in stocks in both scenarios. S&P was up around 4% in both scenarios. Bitcoin was up, I want to say right around there in 2021 and up about like 15 to 20% in 2023. So, this will have a positive, will is a strong word. Whenever you're talking about the future, don't use, declarative statements like will or must or never or always. The future is very uncertain. And so we have to respect that as investors. But it's likely to have a positive influence on asset markets, just given that, we're talking about roughly, I want to say about $660 billion in the TGA now. And if that number trends towards zero in the coming, let's call it 4 to 5 months, that's something that could be really positive for asset markets. That could be a positive dynamic for asset markets. Now, this isn't the only thing that's going to impact asset markets right now, right? If you think about the 4 major cycles that you need to get right as an investor at any given time, it's growth, it's inflation, it's policy, both monetary and fiscal, and it's also liquidity. That we're talking about specifically liquidity. Liquidity can overwhelm the other cycles at times, but the other cycles can overwhelm the liquidity cycle at times, right? If we go into recession, all your thoughts about liquidity are going to go by the wayside. And if we have a significant acceleration in liquidity, any concerns about a modest slowdown in the economy will go by the wayside. If you have a significant acceleration in inflation, people are going to start to get concerned about growth, and they're going to start to get concerned about liquidity. And then obviously, if you have a significant retrenchment of fiscal policy, then they can become very concerned about growth. But it could also be sometimes positive for liquidity. So they're all interconnected. They all are reflexive and they all interplay with each other in asset markets. So it's our job as investors. One of the most important jobs we have as investors is to understand what is the market currently trying to price in the context of those cycles. Each of those cycles is always going to be doing whatever it's doing at any given time, but the market is, I don't want to say ADD might be too, I don't know if I get in trouble for saying this, but like the market is ADD. So like, sorry, not ADD. The market has a very small amount of focus. Its focus budget is very small. It can only kind of focus on one or two main things at any given time. So it's our job as investors to figure out what are those main things that the market is trying to price in, and ultimately what are the things that are changing that the market isn't focused on right now that it will eventually find its way to focusing on, for some, investable time horizon. So I think I've rambled a little bit too much for today, so we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, January 8th, 2025. Best of luck out there today. We will catch you back here on Friday. We're going to be closed tomorrow. So have a great day out there. Cheers.